Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Quynh in Carlsbad, California.
Hi, my name is Quynh-Tram. I'm from Carlsbad, California. I got a job offer from a startup company as a pharmacist there, and I was just wondering what would be a competitive equity stake or stock option in the company, given that I'm the 40th or 50th employee. I've seen things online about engineers, about having like a 0.2% or 0.3% stake in the company, but I don't know what a competitive stake in a company for a pharmacist might be. So I was hoping you could help with that. Thank you.
Thank you, Quynh, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, this is a great question, and it's typically something you don't see a lot, in the pharmacy realm. A lot of the pharmacists that we work with are kind of your typical W-2 employees, for the most part. But I think talking through this, because I think as pharmacy evolves, we may see more and more of these types of non-traditional jobs and things pop up. So I think it's good to have at least some kind of basis here. So what we're talking about here, equity, typically in the form of stock options or even restricted stock units, RSUs, is really kind of the currency of the startup world. So if you're a startup, you kind of have an idea, might not necessarily have a lot of cash or investors. So you're really trading that prospect of kind of this company in the future for, a stake in that company. So startup founders, usually after they take kind of their own equity and what they carve out for themselves, usually use equity or percentages of the company to attract talent and to pay employees that they're inevitably going to take a salary cut in. So it's, hey, I know in the market you can make $100,000, but come work with us. We'll pay you 65, and then you also get this equity stake in the company. So they use this obviously because cash is limited, but also to keep employees focused and motivated on potentially that big payday when the company is either acquired or goes to an IPO, initial public offering, where it gets traded on the market. And actually, my brother works in this space, and I remember he kind of had a similar stake. He worked for less, but then he got a percentage of the company that was an option for him to buy at a very low price, and then it would pay off in the future. And they did a lot of creative things to keep them there, like catering, lunches and dinners and things like that. And it was very much all hands on deck for a, 18 to 36 month, period. So again, we won't get into the big, differences, but there's stock options, the right to purchase shares of a company stock at a strike price or an exercise price. But there's also restricted stock units, which is basically just think of compensation that's awarded to you or vested to you in the form of stock. But to get back to this question of is this a good equity stake or not? It totally depends. So, there's every situation is going to be, every company is going to be different, but every situation is going to be different. So it's not just about the badge number or what number employee you are, which is that's very important. If you think about it, employee number 1 took on a lot more risk than employee number 40. So typically with that risk comes more of that upside or more percentage in the company. You're also going to look at, typical things like skills, your experience in the space, or even seniority. So in a engineer developer world, you're going to give more equity to a senior developer versus a junior developer. Also, like the individual or even the business finances. So from an individual perspective, you might say, hey, I really believe in what this company believes in and what they're trying to do, but I really need more salary, so I'm going to take less, equity. Or it could be the other way around. Hey, I don't need it. I don't need the salary. I just want the upside. So that's also something that you can negotiate and work through. But then also the business finances. So the business might say, hey, this is what we have allocated for salary, but we can give you a lot more of the equity. The big gamble here, and the numbers support, is that equity could be worthless in the future. So you might put a lot of stake in the equity stake, and it could really be worthless. Or you could go to where you're tens of thousands, hundreds of thousands, millions of dollars, even depending on some of those companies that do make it big. So I would say the first thing, I found two resources. Holloway.com has a template showing typical equity levels. They show you what a number 25 employee after like a Series B investment round should be paid at. So they'll give you a lot of kind of a template of where you should be. I don't think what you're saying is, Quynh, is too far off. But then I would also use something called AngelList, which allows you to kind of compare reasonable equity structures amongst companies. So that would be the two resources. But super interesting topic. Again, not necessarily something that we see every day, but I think it's something that again, as pharmacy is disrupted, there could be opportunity for pharmacists to kind of take this non-traditional route, and also compensation structure.
Yeah, great stuff, Tim. And one of the things that I think really stands out to me here is, Quynh mentioned 40th to 50th employee. And, as you're looking at some more of that general data, to your point about it depends on some level, and what are some of the unique skill sets and other factors that might determine this. Is Quynh the first pharmacist, and they've determined a pharmacist is an essential part of this company? We know nothing about the company, of course. Or is Quynh the 10th pharmacist, and somewhat not disposable, but obviously not as unique in terms of being that unique skill set, or that first person or second person that they have on board that has that skill set. The other thing I think about, Tim, is if this were a client, one of the things I would think about is if somebody is foregoing some salary in terms of equity, and obviously that equity may be worth a lot or may end up being worth nothing. Is there a potential bias there? I would think there would be, right? That one who works for their own company, and obviously they're going to be high on what that company is. And how could they, help hedge against that to make sure whatever they're giving up in salary, they're appropriately evaluating that risk?
Yeah, I've seen some people negotiate, and again, there are financial planners that specialize in kind of like tech startup, but they'll evaluate kind of like a compensation package if if it goes under, so that you can negotiate against kind of the downside risk. But I think sometimes there can be bias, because a lot of these situations, there's a lot of emotion involved, because you might really believe in the mission, but at the end of the day, the economics have to work, and it has to turn a profit for the company to basically pay its bills and do its thing. So sometimes you can get blinded. We talk about this more readily in home purchase. You can kind of get blinded by the emotion, but it really has to be kind of an objective decision on what you're making, because if you forego salary today, there can be far-reaching effects. But at the same time, like if you can structure it in a way to kind of protect yourself on the downside, and maybe you split the salary and the equity, or maybe there's some type of package that that there's an exit. It's super important. Again, and the other big thing that we haven't even talked about in this is that the tax consequences of these types of decisions are far-reaching as well. So it's definitely something that I think having an objective third party to sit down and look at it, especially one that specialized this, is going to be really important. So, it's not, and it could be, Quynh, that you're compensated in a way that is equitable to what, a typical pharmacist might be. And this might just be, icing on the cake. But if it's not, then to me, the way that this is structured is going to be really important to, how you proceed.
Yeah, great point about the tax implications here. I could see where that would be an important consideration. Another emphasis on the importance of tying the tax to the financial plan, as we've talked about many times on this show before. So, Tim Baker, great stuff. Quynh, thanks for submitting your question to be featured on this week's episode of Ask a YFP CFP. And as a small thank you, we're going to be sending you a super comfy YFP t-shirt. And to those listening, if you'd like to have your question featured on an upcoming episode, please go to yourfinancialpharmacist.com/ask YFP or shoot us an email at info@yourfinancialpharmacist.com. Have a great rest of your week.